Very good morning. You're watching India Market Open, and I think the market has gotten exactly what it wants. Continuity, stability, and a clear sense of what Modi 3.0, the government is going to look like. Last evening, the names of the ministers obviously out. And I would say, Niraj, and this is something I was telling Alex also earlier this morning, that if alliance partners and formation of government with alliance partners is all about bargaining, then you have to see who's won that negotiation, won in inverted quotes. I think in this case, it's definitely the BJP. They've got exactly what they'd wanted, not had to change much and not had to give too much leeway.
Yeah, and so you're absolutely right. Good morning, Tamanna. And the interesting piece is that, and we are going to play out a Vallabh Bansali interview today. And I was talking to him yesterday, and Vallabhbhai was telling me that maybe for the states, you know this better, but I'm just saying what people are saying. He was saying that maybe for the JDU and maybe even the TDP, instead of getting a plum ministry, getting the financial packages for the states is their victory. So therefore, in some sense, it's a victory for everybody. The BJP gets to keep the policy continuity going. The state ministers maybe get the packages that they might be desiring for the state. Win-win for all, win-win for investors.
So special status has officially been stopped since several years. Some legislative changes will have to be made. And I'm not sure that allies will see it as an either or. So remember, 72 ministers have been sworn in. They can go as high as 80. Some key ministers have got two portfolios. This is BJP portfolios. So there is some to spare if you have to distribute.
Yeah.
But I would say in round one, you've managed to form the government in time, swear in record time, distribute the portfolios and get everything set. So that 240 figure, which was rankling the markets and clearly would have been rankling the BJP, has become, in that sense, a non-event. It hasn't changed anything.
The only point I'm trying to make is, I mean, that it is not I'm not saying you were trying to say that, but all I'm saying is that it's not this versus this. Yeah. I think it's win-win for all allies in the party, because I'm sure that the TDP and the JDU are happy with what's happened thus far, because there is something in the anvil that might be coming.
Yeah. So I mean, the fact is that they've all, accepted those portfolios.
Exactly.
And you had a first cabinet meeting, so they've come to an understanding. I think what's interesting for the street is, let's talk a second about all of the economy-facing portfolios, or what we watch. Number one, Finance Minister Nirmala Sitharaman again. A lot of conjecture and speculation there, but she's back. For the markets, that's at the very least continuity, because you know how this finance minister functions.
Exactly. And
this finance minister functions in tandem and in great coordination with the PMO. So everything is as of pre-4th June in that sense. So Nirmala Sitharaman back in the saddle at the finance ministry. I'm not going to home, defense, external affairs, very, very important, but just from the market's point of view. I want to come to another key one, which is Nitin Gadkari's road and surface transport, only because huge capex ministries, railways, Ashwini Vaishnav back, now with not one or two, but three portfolios. He's not doing telecom, he's doing INB, but IT under him. So semiconductor push, AI policy, and of course the railway infrastructure. So he's going to be a busy man, and he has a lot more work and a lot of stuff which impacts how companies function. So I think that one's important. Piyush Goyal back at commerce, also important as well. And civil aviation, yes, one of those prestige portfolios, but then, there's a few listed companies, and there's little room to what you can do in civil aviation in terms of huge spends.
But also, TDP is known to be a progressive party. I mean, they were amongst the first ones to really get some great things going.
They had civil aviation in NDA 1.0.
Exactly. So I don't think the market would probably fret about this.
Not at all. Jyotiraditya Scindia's got telecom. I would just say that one's interesting, because remember, a very big decision has to be made on Vodafone in this term. Suave minister, a lot of administrative experience. So telecom under him is something which would be seen as positive as well.
Yeah. So out there, great policy continuity. But is the market today maybe about policy continuity, but today and tomorrow, a lot more about global cues and how they will dictate terms.
Yes, I agree. Most of this has now been digested in, and global cues have been, I would say, lukewarm is one way that I would look at it. Muted on Wall Street as well, and I'll just pull up for you what the US markets ended at. Positive but muted because there is, a wait there for a key event as well that we will see in the next 24 to 48 hours. One is the CPI numbers will be out, so that inflation number will be very closely watched in the US for the last month. You will also have the FOMC meeting. No rate cuts expected. Rate cut expectations have been pushed to the end of the calendar year now. But obviously, Street will watch very, very closely what are the indicators coming in. The Treasury yields also showed a bit of that nervousness, so they did tick up. The 10-year at 4.45%. Crude had an unexpected kind of spike, and in part because of a Goldman Sachs report which predicts that crude prices will inch up. They see that summer demand will lead to lower inventories and you'll see prices going up. But that's more of a temporary short-term kind of a phenomena. Nevertheless, you had the Brent back closer to the 82 levels as compared to before. Asia's open mixed. Remember, Bank of Japan, FOMC, all of those cues are going to be watched. In fact, Shanghai is down about 1%, Hang Seng down nearly 2%. So mixed but negatively trending. I'll pull up implied open and see where we are set. Yesterday, you were showing a completely flat opening. Not too different today, I would say, in terms of 33 points up perhaps on the Nifty. And just very interestingly, let's see where the fund flows are. Yesterday, the last half saw, the last bit of trade saw a bit of a sell-off, but nevertheless, FIs have continued to buy. And there's no consistent pattern yet post 5th June. I was trying to look for that where, FIs are consistently buying. But net, they have been buyers. 2,500 crores yesterday. DIs 2,700 crores yesterday as well. And another figure that astonished me, Niraj, and you talked about it yesterday on the show in the morning, is the AMFI data. Record equity inflows. I mean, I don't think granular data is available of what DIIs did or mutual fund investors did exactly on 4th and 5th of June. Yeah. But my guess would be that they went in and bought when they saw an opportunity.
It did happen simply because a lot of, anecdotally, Alex speaking to a lot of mutual fund CEOs suggested that they had some very strong inflows. Remember, the FI boys who were speaking to HDFC, AMC also indicated that. Also, some sectoral NFOs were out in that period, and therefore, even those garnered a lot of money. So I think that is pretty interesting data. And thanks to our producer for pulling that up as well. But the net equity inflows has done very well. I believe Mahima in the production room and just doing what she does best. But let's just get the trade set up and running and try and understand what could happen. Now, this is, of course, conjecture. But one would presume that not just today, but over the next 2 or 3 days, the global cues will likely triumph over policy continuity positives. Now, we may start off well. Will we continue to do well? Because yesterday the markets did come off because the portfolios are not announced at the expected times. I think that's what we believe out here. Now that that is out, is that a positive? Yes. Is policy continuity positive? You've guessed by mine and Tamanna's conversation that we believe it is. But the globe is a bit of a soft place and very unlikely to take a very trending decision ahead of the FOMC commentary tomorrow. Not the decision necessarily, but the commentary. So I would suspect that 23,300, the chance for a very strong upside on the back of policy continuity ahead of the FOMC is limited. That's one view. And if you look at the option data as well, not quite wedged in at the current levels. On the call side, 23,500. On the put side, 23,000. So in some sense, a bit of a wide gap out there if you look at the open interest distribution as well. And the immediate resistance probably at 23,500 for a trader's perspective. But I do think that crude remains firmly in focus because of the uptick today ahead of the OPEC decision coming out later today and the US inventory data and the outlook coming out tomorrow. So oil sensitives may react slightly negatively today and remain in focus. Remember, Interglobe Aviation has other reasons too, but aviation stocks, oil marketing companies may react negatively. paint companies may react negatively, and on the flip side, the upstream oil companies may react positively. So I think this is one pocket to watch out for. Otherwise, a lot of trading plays happening. For anybody who went home on Friday, Tamanna, with a large long position in IT, because the IT stocks were doing so well, got taken to the cleaners. So almost everything is becoming a bit of a trading play.
They should have listened to Neelkant Mishra in the conversation with us at Invest29, who said that he's not very excited about IT for a while. They did have a bounce up because of the ECB rate cuts, but not enough steam.
Yeah. So that's the trading play. And the last piece, Tamanna, very interesting. I think everybody will keep a keen eye out for what the government is saying or doing. Like yesterday, fertilizer stocks, right? The PM releasing the installment of the Kisan Samman Nidhi.
Yeah.
Just led to those stocks flaring up.
You know, and that's funny because that's par for the course, right? That money was supposed to come.
Yeah.
But the symbolism of it, that's the first thing he chose to do right after. And even the housing finance companies, yesterday, your Aadhar Housing Finance, Hotco, all of them having a dream run. Because that's the other first big thing that the cabinet did. Sanction 3 crore more houses. Or
the belief that GST on cement might come off, and look at what the cement stocks did yesterday.
But what is that based on? Because that's still a GST council decision. Finance ministers of states have to take that. But, you know, I had a question for you, Niraj, and I'm wondering, before the whole election frenzy started and, you know, everyone was wondering what's going to happen, etc., there was this sort of care about capital gains tax or you know, changes thereon. I'm wondering if that now comes back, because if you've come back effectively to status quo, you've come back to pre-June 4th status quo, so then do those old concerns sort of carry forward is something I'm wondering.
Yeah, and it's a big thing because the opinion out there is so divided. We've had the Avengers guys out here saying why upset the Apple cart, and it's an important statistic. But yesterday, Gautam Trivedi of Nepean was saying that why not bring that under tax to reduce the volume for the long-term benefit, because a lot of tier 2, tier 3 people who've just come into the markets are burning their hands on options trading. Why should they? And so, you know, difficult to say. What if the margin requirements go up? But I don't think it's a budget thing. A margin requirement going up is a decision that the regulator, or SEBI, etc., will take, or the exchanges might kind of release, not necessarily a thing of the budget. So, because it's already in the maximum tax slab. So what more can the government do on options on the taxation front? Remains to be seen, really.
Yeah.
But interesting that you pointed it out, because yes, it probably slipped a lot of people's attention, but there is policy continuity out there, and the belief that they want to do something around capital gains could be interesting times.
Correct. You know, it's logical. If you're coming back to status quo, then all your old fears also come back, because remember, nothing has changed in the finance ministry per se. All right, stocks. Let's talk stocks this morning and what looks interesting. We talked about the housing finance play. We talked about the fertilizer play. Those are themes that you may see continuing once again. But let me just add a few as well now that the ministry's portfolios are out. IRB infrastructure on my radar. IRB took a complete knock yesterday. Now, there is some news, and this could be one of the reasons why the stock had not done very well, which is Sintra is looking to sell around 5% stake in IRB. Remember, that stock was down nearly 9% yesterday at $228 million. The floor price is at a discount to this closing price you're seeing at 70.16, in fact, nearly a 10% discount. And Sintra had a 24.86% stake. But I would watch IRB simply because you have, once again, continuity in those ministries. You know, the road, surface transport, etc. A lot of focus on infrastructure will continue, so IRB is one to watch. Rail Vikas Nigam is another one, and I would add the whole railway pack of stocks as well. Again, a continuity kind of a flow. But in this specific case, there's a consortium, the Siemens RVNL consortium, which has got an LOA from the Bengaluru Metro Rail Corporation. From the last couple of days, they've emerged the lowest bidder for a lot of Indian railway projects as well. But this is specifically the Bengaluru Metro Corporation. The execution time period is 130 weeks and cost of consideration is 394 crores. Remember, Siemens has a 70% share in that joint venture, but nevertheless, positive news for RVNL. There are a lot more, but I'm just going to pick one more before in this sort of first cut before I come to Niraj, which is Vodafone Idea. Again, couple of things working for Vodafone Idea. Now you have a new telecom minister. The government still is a very, very crucial and I think single largest shareholder even now in Vodafone Idea. They have to decide what to do with the dues they are owed. You have a new minister in Jyotiraditya Scindia. But the news trigger is not just that. They are going to consider a fundraise in a June 13th board meeting. Now, this is slightly different from the 18,000 crores they've already raised. Remember, they want to raise 45,000 crores in all. But in this particular fundraise round, they want to consider and giving equity shares or convertible securities to their vendors. So this is fairly clever because remember, this is a debt-ridden company, even though the stock has been doing, if I pull up the last couple of weeks, fairly well, but it is a debt-ridden company, and this is one way in which Vodafone perhaps hopes to pare its debt. I would watch Vodafone and Indus Towers. Yeah,
certainly watch out for each of these. So certainly something to keep an eye out for. Now, Tamanna probably addressed Interglobe Aviation as well, but just wanted to lay out.
I haven't, but that's an important
because
one.
That's the other important block deal. I mean, IRB is one, and that 10% discount is large. On Interglobe Aviation 2, a 7% discount on the block deal. Bhatia family unit, Interglobe Enterprises, will sell about 2% stake via block deals. Now, this is important, viewers, because of two reasons. One, this is not the Gangwal family. This is the Bhatia faction selling out its stake. Where the Gangwal faction, the cooling period, the 5 months is not over as yet. So now for the street to see this block deal and then an upcoming block deal from the Gangwal family after the cooling period is over, plus crude prices being higher today, plus the stock having rallied so much, means that very likely that Interglobe Aviation could be under pressure today. So do watch out for this one. Very likely will start off lower and could stay lower. So that's the one. And I'm surprised if Tamanna has not spoken about Honasa because she loves speaking about Honasa, but that's the third block deal, right? That could come in focus as well. So watch out for Honasa Consumer 2, maybe a block deal there. So that's the first stock. But Interglobe Aviation is the first stock on my radar. I thought life insurance stocks were interesting simply because the private players have had a really strong growth period. So if you just look at the growth for life insurance companies, growth was strong for the private players at about 25% YOY in May 2024 versus about 25% in April, which means that the growth continues from April, and about 10% growth in May 2023. So YOY there is strong growth. Month on month, there is a continuation of growth. So HDFC Life, SBI Life, ICICI, all of them strong numbers and could well continue. Watch out. Remember, yesterday HDFC Life was amongst the top 10 gainers, and therefore maybe, just maybe, some of these positives could continue as well. And Trill could be interesting because it's just such an active stock, Tamanna. QIP, if it's successful, while it's at a 4.5% discount, could well pick up in trade.
Yeah, just a couple of more and I'll breeze through them because I'm very excited about our next guest. And that's the big one. Our timing is perfect. So should we give it away? Should we give it away? Rhythm Desai is going to be in our studios in the next couple of minutes. So we're super excited about that. But just very quickly, Raymond, second redevelopment project in Bandra East, not very far from where our office is. 2,000 crore rupees. I'd watch out for Raymond. I would say KEC International. Remember, 1,000 crore plus of orders yesterday, and that stock was doing very well. There's a Nomura note out which sees a target price of 960, so you might see more upside there. Just the last one, Hindustan Construction. Elara Capital has a buy with 63 rupees. I thought this was interesting because this is one of those infra stocks which is just generally languishing, and that target price caught my eye, upside of 65%. So HCC is the other one.
Yeah, and they are saying that it will come out a long period of pain.
Yes.
Will it come out of that pain and all of that? So
that's what I'm saying, completely languishing. They've done one interesting piece of the Mumbai infra on the Bandra Worli ceiling extension as well. So Ajit Gulabchand, I mean, it's a season of comebacks. Can he make one? I'm not sure.
You bet. Yeah. So fairly interesting set of stocks, a wide range of stocks, of course. But, if you're looking for range of stocks, before you take the break and get in Rhythm Desai, an important thing to focus on is what the derivative cues are saying. And let's get in my colleague Agam Vakil to talk about what's happening at the derivative end of the market as well. And Agam, Good morning to you. Just trying to understand how have you gauged the derivative picture as of close yesterday and what it could imply for today?
Morning, Niraj. Well, what we're looking at now is a little bit of consolidation now that the dust is settled. Volatility has come off substantially. We're looking at a little bit more stability when it comes to the change in price movements. And it's very evident in the kind of cues that we're seeing as far as the futures and options space goes. So when it comes to the Nifty, marginally in the red yesterday, a lot of unwinding in terms of our positions. The bank Nifty, the picture is not very different. Again, unwinding coming through. In terms of the options market, well, we're keeping an eye on levels around the 23,000 mark. We did see, fairly mixed sort of traction when it comes to yesterday's day of trade. Of course, as we move into this week, the levels that we are keeping an eye on is 23,000 on the lower end and 23,500 on the higher end. That's where we're seeing a good amount of accumulation in open interest in the respective puts as well as calls. And in terms of stocks, we're keeping an eye on, well, it was a mixed day of trade, but we're watching out for longs in Ramco Cement and India Cement. Emphasis on Coforge under pressure, looking at shorts among stocks which saw unwinding. Well, again, that's where we see short covering for Syngene International and Divi's Laboratories. Bharat Forge, Manappuram Finance and ICICI Bank looking at a bout of longs and winding. Overall, a mixed picture, and that's what we're going to take over and potentially see a continuation of trend today as well.
Right, thank you for that, Agam, and thank you for breezing through that segment today, because on the other side, we have Ridham Desai of Morgan Stanley coming into our studios. We're very excited about that. In fact, you're seeing there live pictures. I don't think he can hear us, but hi, Ridham, waiting for you in the studio. So as they start that walk in here, Ridham, the timing of this couldn't be better, isn't it, Niraj?
Yeah. No, Tamanna, Ridham can't hear us right now. We haven't mic'd him up officially, but I can tell you for sure that the next 20-25 minutes that we're talking to him are going to be fabulous, because this is on the eve of their investor conference starting tomorrow and just after the portfolios have been allocated. So great time to have you, Ridham. Looking forward to the conversation.
Pleasure.
Okay, we'll be back after this very short break with none other than Ridham Desai. All right, back with India Market Open right here on NDTV Profit, and we have the man who a lot of people want to hear views about on all things possible in investing. Ridham Desai, Managing Director and Chief Equity Strategist India at Morgan Stanley, joins us right now. Well, on the eve, or rather, on the eve of your investor conference, and this is what, the 26th investor conference. Yeah, and we'll talk about that as well, Ridham. But can't not start off by talking about how do you gauge the landscape currently after what arguably seems to be policy continuity with all the major portfolios retained by the BJP and the markets celebrating it thus far, but the world markets maybe slightly skittish ahead of the FOMC. So perfect timing to have you. Good morning.
Yeah, good morning. Great to be here. It's a lovely studio. I'm really impressed.
Thank you.
And I'm so happy I made it here
instead
of interviewing in the Taj. I think there was a bit of nervousness on Tuesday afternoon because it seemed like we were going to have a little bit of a problem, but I think things shaped up well. I'm not surprised. I wrote a note overnight on Tuesday that this is continuity and just treated like a majority government. I have great confidence that this administration will basically continue the work of the last 10 years and actually accelerate things. So I think that's the message from the electorate. If there are multiple messages here. There are political messages, which we will not discuss because they're not relevant to the market. And then the economic message is that I think there are a few people that are still behind the poverty line. Obviously there are. The number has gone down by 10 points over the last 10 years, but there is still, maybe 15% of India that is below poverty line. And to lift them, and this is where I am counterintuitively suggesting to investors who concluded on Tuesday that we are now going to be back to populism. I think we're going to be exactly the opposite. In order to bring those people up, distributing cash doesn't work. Distributing cash has never made poor people rich. Okay, it may win you votes, but it doesn't make poor people rich. What makes poor people rich is you lift the growth rate and therefore create more opportunities. And the BJP led NDA in the last 10 years, and I keep saying this, is that the Prime Minister is an inflation hawk. So that is what informs all policy making. So, the classic example of this is COVID. When the world was distributing cash, this government chose to distribute food because cash would leave an inflation imprint that will hurt later. And the FOMC context is precisely there, right? They're still struggling to get inflation back to where they want it to be. So that does not happen. And what happens instead is an endeavor to lift India's growth rate, because at 7%, X number of people get jobs. At 8%, that number goes up materially. So you lift India's growth rate, and at the same time, you don't let inflation pressures build. It's a very tight balancing act, but this is what I think the government is going to attempt to do. And then you just imagine how bullish that is for stocks.
Yeah.
Okay, that's Goldilocks multiplied by 5.
But just wondering though, one follow-up to that. Growth impulse from the government can come in via some fiscal measures, not necessarily reforms, because reforms in the near term, in the very short term, might actually not really lead to growth stimulus in the near term, right? So if indeed do you forecast or do you believe that there could be fiscal impulses given in order to boost growth? Because the consensus
Niraj,
is 6.5 to 7.
No, that's not the template. That template is not. Government spent during COVID because the private sector retracted. That is over now. The interim budget already told us that the government is stepping back. I don't expect any reversal in that thinking. Okay, that's exactly the point.
Right.
The template is for the government to step back and let the private sector crowd in. See, the private balance sheets are pristine right now, especially corporate balance sheets. 50% debt to equity. There's a lot of room to borrow, right? The government has been crowding out that because it had obviously judged that the private sector will be reluctant coming out of COVID. Now that heavy lifting is done. So the government is stepping back. India is the likely only large economy in the world, the top 15-20 economies, that could be in a primary balance in 3 years from now. And you have to understand the implications of a primary balance. So just for the audience, a primary balance is when you are not borrowing money to pay interest cost. The fiscal deficit is the total expenditure minus the total revenues. The primary balance or the primary deficit is what you have before you pay your interest cost. Now, at a corporate level, if you are borrowing to pay interest costs, you're bankrupt. Governments don't go bankrupt because they print money.
Correct.
Right? When you get into a primary balance, and given that nominal growth is 10-11%, you get a major deleveraging on government's balance sheet. And that has not happened in India's history. We've had 2 years in the last 75 odd years when India had a primary balance, but it was not by design. It was by luck of a very strong economy.
Which two years?
2007, 2008.
Okay.
So, 2007, fiscal F7 and F8. You know what the markets did in those 2 years.
Yeah. In the midst of the GFC.
So that is exactly what we are set up for in the next 3-4 years. So I think we go into a primary balance, it triggers a major re-leveraging of corporate balance sheets, and that's how growth gets lifted. This is benign for inflation because it's investment-led. See, look at the government's response yesterday. It was basically, let's build more homes. Investing your revenues does not trigger inflation. It's when you redistribute it. That's when you leave inflation impulses in the system, which then go out of control at beyond a certain time. So I think the impulse will be to trigger an investment cycle. And very 101 on economics is when the investment rate is rising, corporate profit share in GDP is rising. And there's a virtuous cycle. As profit share in GDP rises, corporate saving goes up and they invest more.
Right.
And all this continues until you reach a level where the incremental investments become unproductive. That will happen at one point in time in the cycle, but we're still not there. We're about halfway through the cycle.
Yeah.
So we have a long way to go before we get there. That's what happened in 2009-10. Investments became unproductive, and that's why the economy, and of course there were other things that happened because we let inflation out of control. The fiscal and monetary stimulus was excessive. And I have this view that Manrega proved to be quite lethal because it fueled labor cost and did not have a corresponding investment around it. And that brought double-digit inflation and was the real foundational reason why the UPA lost elections in 2014, because poor people were impoverished. And even though we don't get annual data on poverty, I am sure that in 2014 poverty was at a multi-year high.
Right. Yeah.
Despite Manrega. See, this is what redistribution.
In fact, you're saying in because of Manrega.
Yeah, I'm saying because of Manrega. But it's not the single reason, because a lot of other things happened around that time. So I don't expect such policy responses.
Right.
I think especially foreign investors as a cohort, not individuals, misread India's politics quite a lot. And they don't understand. And look at yesterday's cabinet formation. Okay? Continuity at an extreme level, which is essentially, it's almost like the Prime Minister is telling his cabinet, listen, your 2-month break is over, let's get back to work.
Yeah, exactly.
So that's we're basically, it's business as usual.
Right.
So nobody has to learn anything new. There are a few moves, but nothing dramatic. So everything is as it was, and life goes on, and therefore they can press the pedal and move forward. Now, I know I'm not allowing you to ask any questions, but I'm anticipating your questions.
We're loving listening
There is
to
a
you.
50 basis points room that the government has earned in these 2 months since, or rather 4 months since the interim was announced, right? The base number is down 20. So instead of 5.8, it came at 5.6, and then the RBI has given a 30 basis points dividend check. So it'll be interesting to see what the government does with this 50. Okay, I don't think they will take the deficit down to 4.6 because I think that's too much of a contraction in a single year. The likelihood is that the deficit will be 5.1, and the remaining amount will be available for the government to spend. And I don't think that's priced into the market. That's a lot of money actually waiting to be spent.
In fact,
and that's good for liquidity. It's good for growth. It does set us up, and if the rain gods are, and I think my science tells me, and I disagree with climatologists that this was climate change. This was a ferocious El Nino which created this heat wave in India, and it is being followed by a equally strong La Nina. So come August, we're not going to be liking to come to office. Yeah. Because it's going to be raining a lot. So I'm expecting a very strong monsoon. Hopefully it's not, it doesn't cause damage, but it'll be a very strong rainfall, probably the best that we've had in a few years. So that sets us up for good farm output. The government has a little extra cash in its back pocket without compromising on the fisc. And I think, corporate sentiment should be good.
Right. Yeah. Can I come back to the private capex cycle? I think everything now seems to be still driven by the government's capex, Kitty. The private sector is not coming in a way that we need to scale up. See, for the next 5 years, if we have to scale up, now it's a question of scaling up. We can't just say that we'll do a bit here and a bit there. Do you think that private capex is coming in a way that can meet the ambitions that have been set for the next 5 or even 10 years?
Let me share the numbers with you. So the last time we had a capex cycle in the private sector was the period between 2004 and 2010.
Right.
Now the starting point in 2004 was 4% of GDP, which is corporate capex was 4% of GDP. GDP was a lot smaller then. It was almost 1/8 the current size. By 2010, that number went to 17. We had never witnessed such a capex cycle in our life. Okay, and Nifty earnings in the period between 04 and 08 compounded at about 30%. Okay, that's not our base case right now.
Yeah.
Okay, for a few reasons, I'll explain those. The private corporate capex cycle troughed at 4 in this cycle again. So from 17, it went all the way back down to 4 by 2020 second quarter, which was the end of during the first wave of COVID, and is now sitting at about 5. Okay, so it has inched higher. It is now off the lows. I think this 5 goes to 10. I don't think it's going back to 17. And there are reasons for this. One very important reason is India's ICOR has gone down. So let me explain that. ICOR stands for Incremental Capital Output Ratio.
Yeah.
Okay, that is the efficiency of capital that is available in the country. So our capital was a lot more inefficient 15 or 20 years ago. So for every dollar of growth, we needed $4 of capital, okay? And therefore you needed to invest that much more in order to generate a certain amount of growth rate. The second thing that has changed is the actual headline growth rate that the government is targeting. Now I have heard this multiple times from government, and I agree with them that India is just not ready for 9% growth. If you try to push 9% growth, then you will trigger inflation. And the growth cycle will end, like it did in that period.
Yeah.
Okay. Now at 9% growth with ICOR at 4, you need an investment rate of 36%. But at 7% growth and ICOR, which arguably is lower than 4 because India's capital efficiency has improved for many reasons. We can go into those details, but infrastructure, GST, financial system, digitalization, internet, broadband, everything has changed the incremental capital output ratio. The amount of capital I need is a lot lower, and hence I get more bang for the same dollar buck that I'm investing today than I got then. So if you are looking at that cycle and saying, oh, we're not yet there, we're not going to get there, and yet we will have robust growth rate. Now, if you decide that you want to push growth from 7 to 8, and your ICOR is say 3.8, you will need about 30% of GDP as capital, still a good 600 basis points lower than that time, and that is reflected in my forecast, which is we're not going back to 17, we're probably going to peak at 10.
Rhythm, just on follow up on that CapEx question and some of the points that you've made. You're saying that no course correction will be required in policy. But I want to link a couple of things. Rural incomes not growing at the same pace, the question of unemployment, all of these came up politically and maybe got amplified for political reasons, but I'll leave that aside. The fact is that private capex is also waiting for consumption levels at bottom of the pyramid to grow to that extent. Every theme we talk about is premiumization. What push do you see to make that happen as well, where you have a more sort of secular growth rate?
You mean broad-based?
Broad-based.
Yeah. So let me admit one thing. I think coming out of COVID, we underestimated rural distress. Okay, so I was of the view that rural growth should have turned last year, but it didn't. And it has taken a little longer for the impulses from urban India to slip into rural India. So I think it is happening now, actually. So you can see that in corporate commentary. We have leading indicators which actually tell us that rural growth is improving. You can see it in the two-wheeler data, you can see it in what consumer staple companies reported last quarter. Yeah. It's finally turned. Okay, so that filtering of growth down has happened. The second thing which you must understand is that the government in the last 3 years during COVID has focused essentially on investments, and therefore the share of investments has risen in GDP. Okay, now GDP contains investment, consumption, and your external deficit. Okay, if the share of investments is going up and the external deficit has gone up down slightly, consumption cannot be at the same level, it has to lose share. So on a nominal growth basis, consumption growth has trailed investment growth. And that is how an investment cycle behaves. And that will continue to be the way it will happen over the next 4 or 5 years as the investment rate gains share. Unless you go into a current account surplus, which I don't think will happen. So we'll probably have a much narrower current account deficit. Consumption will lose a little bit of share, investments will gain. Then as the investment cycle matures and as things peak out there, that's when consumption comes back. So this is not the time when on a relative basis, again, and rural India reflects most in the stock market parlance, it reflects into consumer staple stocks. They underperform in the 03-07 cycle. And their outperformance started in February 8. So from a stock market perspective, it's certainly not the place to be. You don't want to buy consumer staple stocks. Yeah. I mean, there may be pops and trading pops. And there was one last Tuesday because everybody thought populism is back. And it was a great moment to sell the stocks again and come back into industrials, which, took a little bit of a backseat. But I think industrials and financials will lead the pack. Consumer staples will be trailing. So that's from a market perspective. But I think the rural economy is already improving at the margin.
No, so since we're talking about the market perspective, let me take that opportunity. Industrials you like, financials you like. You talked about government capex not being at the same levels. But what about, your core sort of infra spends, railways, defense, Make in India, all of that, you think continues at the same pace?
No,
Were you ever bullish on it?
No, Make in India is not government spending.
PLI scheme, PLI scheme.
So I'll come to that. PLI continues, probably expands, gets even more refined, but the key infrastructure sector that I would be constructive on is railways. Yeah. Because that's where all the heavy lifting is now going to happen. The endeavor is to lower India's logistics cost maybe by 30-40% over the next 5 years. And therefore, the happy news here is that we have continuity in the railways. Because the outgoing minister and the incoming minister has already done a lot of work in the last 3 years. We wrote extensively about this about 6 weeks ago, about all the changes, and it's dramatic. I remember we had written a report in 2015. The average speed of a cargo train in India then was 20 kilometers an hour. You could cycle faster. Okay. Yeah. We've already come a long way from there. Okay. Now that speed has doubled, it will double again. So if the cargo, now think about the macro and the micro implications. If cargo on the trains is moving faster, it becomes cheaper to transport goods point to A to point B. Importantly, the inventory in the system goes down. Okay, so balance sheets become better. This is about ICOR. You need less capital to grow your business. So the implications in the next 4-5 years will unfold and surprise us on to the upside. Right. So if there was one infrastructure sector where I think the government is going to lend greater attention to, I think it's railways. Now in the other sectors, I think the template has been set up, which is the gross spending will remain okay, but the net spending may actually decline because the government may actually start selling some of these assets more aggressively to fund incremental stuff. So everybody in the market, when they think privatization, they only think about government companies. Yeah. But you should be thinking government assets. They don't need to be corporatized in order to be sold. When you sell a road, you're still selling a government asset, you're still privatizing something, right? That activity, I think, will be very strong. And it will allow the government to fund the next road. It will allow the government to fund a host of rural roads that need to be built where you don't get the same economics, or in fact zero economics compared to a highway. And the railways will get money out of the budget. So I think that's how I am thinking in a very big picture way.
Right, yeah.
Okay.
I have one question. To take this back to the market, when I'm saying market, I'm not talking about Nifty target or Sensex target. Today, the market that we are seeing is different from the market that we saw 5 years back. 5 years hence, a large number of small cap companies, engineering companies, some of the older ones, they are all coming to the fore. So what I see today, the 1,000 stocks that I see could be different 5 years from now. So the market texture could change completely the way we are moving ahead.
Oh, you mean to say in terms of share of market cap of various companies?
No, not just market cap, in terms of mix of companies. Today a small cap company is getting so many orders. Mid cap companies are getting so much orders. Now some of them would have grown so big if they are on this efficient path that we are looking at implementation and efficiency, right now. So they would look completely different. So forget the Nifty target or the Sensex target. That's par for course. That math you've always been telling us. But the choice of stocks could be completely different if you look 5 years from now.
It's possible, but as such, the composition of the market in terms of sectors always changes from cycle to cycle. So it does not remain constant. So, at the peak of this cycle, consumer staples will lose share. Financials and industrials will gain. Discretionary consumption will gain. A few other sectors will lose share. And
technology? As in IT?
Technology is, I think, very interesting.
Yeah.
So, I tend to be quite bullish on some pockets on a 5-year basis. Cyclically, I'm more constructive. But technology may not gain share, may quite lose share a bit at the peak.
Yeah.
At the peak. Okay. But it all depends. Then, of course, there are going to be a plethora of new listings. And I cannot really anticipate the sector diversity of the new listings, but we are going to get a very big primary cycle, very big one. In fact, it's just about to unfold in like the next 15 days. And a lot of companies will file to raise money, and therefore I think the markets will be less exuberant than they seem now, because the supply will come, and therefore it will become a more stock selective market. If I were to make a prediction by December, the Nifty will have, even before that, may have just exhausted for a while.
Okay. So, Rhythm, a large primary market sucking out capital, but domestic staying true to the fore, and that capital likely continuing. Is that the base case? You made it a few years ago. It's panned out very well. Does it continue?
Yeah.
Part two of my question: what about the Goras?
See, the domestic investors are going to continue investing. Okay. Because of many changes that have been put into place. We created an acronym called DREAM, which stands for demographics, real rates, and policy changes and education. So a lot of things have changed. The household balance sheet accrues about $700 billion of saving at the current GDP rate. And if you look at last month's number, you're still annualizing at about 50-60 billion. So you've not even reached 10% of that number, right? The lowest amongst the developed world in terms of household saving into equities is Japan at 12. And Japan, by the way, is now back to equities. Okay, so they are coming back in a big way. European balance sheets have more than 50% in stocks. US balance sheets, household balance sheets have more than 40% in stocks. So we are nowhere close. So this has got many miles to travel. In fact, I am speculating that the government may even allow retirement funds to invest more. So today they are capped at 15% of incremental. The experience has been awesome in the last 9 years. This was allowed by the Prime Minister in 2015. So it's now been almost a decade. And I think the retirees are going to be quite happy because they're getting better and better returns even though interest rates are lower. The Provident Fund is able to deliver because of equity markets. And it makes sense for a long-term fund manager like the Provident Fund to be invested in equities. That's what happened in the US when President Reagan allowed 401k plans to invest in stocks. There, it ended with the NASDAQ bubble in about 20 years. Here, I think it will run a little longer. Our people don't age like they did in America for a long time. So I dare say another 20, 30 years to go. So that's on domestic flows. Now see, in the market, and I say this and I get tired of saying this, there are only two cohorts, right? There are domestics and there are foreigners. If you look at last month's clip, they were putting about $200 million a day into the market. So imagine if domestic funds decide that they don't want to buy for 5 days. It's $1 billion now to invest. You don't do for 2 weeks and you have $2 billion, right? It's a lot of money. And therefore, they have to come every day to buy stocks. Somebody has to sell. So foreigners are selling. Now this will change when the corporate issuers is in the game. So once primary issuances pick up, and therefore you now have the third cohort in the market and a fresh seller, you will find, ironically, the foreigner will come to buy. So if you ask me for a prediction, next 6 months, foreigners are going to buy India.
Okay, and I'm just tying this in because we have 5 minutes left with the investor conference.
I'll tell you one more thing.
Yeah, please, okay.
So yesterday, 3 days ago, somebody asked me this question, a client of ours, that, currently if you look at the emerging market funds, foreign investors are about 50 basis points underweight India. So India has a 17% index weight and foreign investments may be around 16.5. So the question was, how much money does it take for foreigners to go another 100 basis points higher? So slightly overweight from their underweight. And the answer is $50 billion US.
Oh God.
Okay. And the problem is that the maximum that they've ever put to work in a single year is 35.
Okay.
So now you are stuck because this is amongst the best performing markets in the world. You're underweight and you're struggling to deliver performance. And to go overweight, the amount of money that you need to put is just not feasible. The market cannot take that much.
So what will your clients ask you at the investor conference which starts tomorrow? Because capital gains might be in focus. You mentioned that your capital market shouldn't be tinkered with. And this is what, the 26th edition of your investor conference?
It is.
Okay, so tell us a bit about the conference.
Yeah, so we have over 300 investors coming in. I think we have about 75 or 80 companies presenting at the summit. We have a few macro sessions as well. I have a special session on deep tech. I am very bullish on deep tech, and I think it's an underappreciated space, and it could be a major growth driver for India into the next few years. India actually has never been renowned for innovation, but what's happening in the deep tech space, I think, will surprise a lot of investors. So that's what's happening. It's a mix of companies from industrials, financials, consumers, energy. I think we have a bit of focus on energy transition because that's a big theme for the next few years. I think aerospace, PLIs, the build out in infrastructure, the overall manufacturing space, I think, remains a big theme. Our view is manufacturing gains share in GDP over the next 10 years, and therefore services will lose a bit of share. Agriculture, I think, retains. So the summit is around this. The main question that is haunting investors abroad, it doesn't bother investors here because we can't put money to work in size elsewhere, right? So until that changes, if we want to buy an equity asset class, then it's only India. For foreigners, the problem is this 21 times Nifty multiple, and they're not able to digest it. Yeah. So there are only two markets in the world that trade at such fancy multiples, the US and India. India trades at this multiple, in my view, for legitimate reasons. We have a strong earnings growth cycle. We're only halfway through. We have strong terminal growth because of our demographics, and our beta to EM is down to 0.3. It used to be 1.3. So the expected rate of return has fallen. So all this means that you're going to trade at higher multiples. In very layman terms, essentially equities are trading closer to bonds than emerging market equities. Okay, because bond cash flows are assured. Every year you're going to get it, right? So that's how the Indian equity markets are behaving. At some point in time, it will become a bubble. We're not there. We'll get there at some point in time, and that will be the moment to exit the stock market. The economy may still be doing very well, but that may not matter because the markets could have priced in everything. But I don't think it has happened so far. So I think that's one debate. And the second is, I think investors want to get a pulse of how corporate spending will pan out, the question that he asked. So, what are companies saying about their balance sheets? Are they about to start leveraging? Are they about to build big capacities? And I think the third thing will be around macro policy. So some insights into how macro policy will go. Though I think we're probably going to get more momentum behind all the core policies of the outgoing government in this new government. And that message seems to be fairly clear over the last few days.
But let me ask you as we let you go, Rhythm. You're very, very bullish on India's future. What are the three things, and we've seen continuity, etc. But if I were to ask you three things that you hope to see, new and improved, but from the same government and the same team in term 3.
Hope.
Yeah, hope to see.
I'm hoping, not expecting. So there's a difference between hope and expectation.
Okay.
I'm hoping that farm laws are brought back to the table. I think for the 200 million farmers in this country, that's going to be the 1991 moment as it was for the industrial sector. And it will ensure that India accelerates on its growth path and becomes a much bigger per capita income than it is today. The farm sector requires urgent reform. So that I think is one I'm hoping, not expecting though. The other thing I think would be, and you have specifically asked for hope, right? Not expectation.
You can add an expect. 2 hope and 1 expect.
No, so expectations are very clear. Expectation, I think we are heading for much lower primary deficit and probably a primary balance in the next 3-4 years. I think we'll continue to see pointed incentives for the manufacturing sector. It will come in many ways. It will come through rationalization of GST. It will come through infrastructure build. It will come through social infrastructure build. It will come through PLIs. It will come through various methods. It will come through greater FDI. So I think those expectations are fairly clear. Another hope I have, which is not necessarily an expectation, is that we should strike a few deals with foreign companies and get them home as quickly as we can. I think we have been a little bit slow on FDI relative to my expectations. So I hope that it can be accelerated. I think the last year or so, maybe there were other things to attend to. But now I think is the moment for us to. There is a vacancy in the world, from the multipolar world and China +1, and I think we can occupy that spot quickly now. So yeah, maybe these two things. 2 hopes, 1 expectation. No, expectations are many. I think I will be right on most of them, and they're all detailed in my report. Yeah. In fact, there are so many of them that I lose track of those expectations. Those will all come through. Okay. But the couple of hopes that I have, I think the FDI thing will still come through. Farm law, I am not very sure. I think it's a toss-up.
Mr. Musk is excited. Now that all is done and dusted, he's already waiting. But what an absolute pleasure, Rhythm. Yeah. Thank you so much.
Yeah, we didn't touch upon one thing. Sorry, do we have a minute?
Of course, of course.
Risk factors. Everybody should be aware. This is not the equities are not a straight line asset class. You don't get up every morning and get a interest, coupon in your bank account. So people should be very conscious of that. I think most of the risk for India are from the world. I think China's deflation is a risk because Indian companies will have to compete with Chinese pricing, which is going to get very competitive and even more competitive. There's a possibility that a renminbi depreciates, which will make it harder for India to compete with China. I think we have to worry about global growth. Unfortunately for India, it does not have the same global growth tailwind that China had when it was doing its jig. Right. So India will have to counter a much slower global growth because the world has since then aged and it is also far more indebted than it used to be 20 years ago. So it's not a very pretty world out there. So I think that's the second thing I would worry about. And back home, I think we have, and I expect this, so this is not hope, but I expect it, capacity creation in 4 areas: judiciary, bureaucracy, education and health. Now, education and health are complex because they are, also state subjects. So it has to be, the delivery has to be at the state level. But judiciary and bureaucracy, I think, will occupy a lot of attention in the Prime Minister's office. India has a great contract law, but to enforce it is not easy because the judiciary is is bursting at the seams. And really, if you want to accelerate from 7% to say 9% growth, that could become an impediment.
Okay. Well, but as the note said, this remains India's decade, and in some sense, it's good to identify risks in a period which is going to be very good for India Inc., Indian markets, and more. So, Rhythm, thanks for laying it out for us, and all of us here wish you all the best for your investor conference.
Thank you so much, Niraj. Thank you.
Pleasure having you.
Super excited to talk to you. What a great conversation.
Absolutely.
Rhythm Desai there, and we wish we had more time with him, but we need to get to the business of now. Pre-open race are just about to hit. Rajat Bose with us this morning. We're also speaking today with Pankaj Pandey. I'll get a quick word from Rajat first. Rajat, after the kind of, I would say, tepid day we had yesterday, now that we have the Council of Ministers, Cabinet, all of that in place, do you expect an uptick? At least the first cut of the pre-open race are showing a bit of pressure on the Nifty?
Well, initial pressure may be there, but unless there is a significant fall, I think the current bullishness might still remain. If it were to cross, say, 23,400 decisively, then 23,700 would be the target. And I continue to maintain that the maximum excursion on the upside before a major correction happens, that will be 24,150. So till such time, these two levels, the 23,700 and 24,150, are not taken out. The excursion on the upside can still continue, but I expect a lot of volatility in today's session because there had been some stocks yesterday that had been performing pretty well. At the same time, lots of stocks like IRB Infra or say in IT, Coforge, this kind of stocks were showing weakness. And you have life insurance companies doing well, and also some pens companies. They are also doing pretty well. In fact, I have chosen one of the pens companies as my today's picks.
Which one, Rajat?
Sorry?
Which one? Since you've chosen one of the pens, since you talked about
I've
your picks, let's
Barger.
get to those.
I've chosen Barger Paints. Barger Paints, it closed yesterday at 492, and my targets are say 500 and 505, because why 505 is the final target I've chosen? Because there are two moving averages. I think 20 and 50-day moving averages are located there. So it would be difficult for Barger to take out 505 decisively. And on the downside, till such time it falls below 484. So that's why I've chosen my stop loss at 483.75. But Barger is actually bottoming out. So even though it may not move beyond 505 today, but it can still go further up going forward. So Barger should be kept under close watch. And the other stock is Cipla. Cipla, it did post a good run yesterday, and today also I'm expecting it to do pretty well. Cipla, I would say buy at current levels, 1534 it closed. Actually, it has given a range breakout. And when a range breakout happens with good volume, most of the places you will see volumes are not that great. In Cipla, despite the fact that it is doing, it is at a high level, yet it showed good volume activity. And that's why the targets would be 1549 and 1571. 1571 because between 1570 and 1580, there is likely to be a lot of selling pressure, and some profit taking can happen. And this stock will become a problematic case once again if it were to fall below 1513. So 1513 is my stop loss.
All right. Pankaj Pandey also with us this morning. Pankaj, very good morning to you. And I was just looking at what the pre-open rates are showing us. All your block deal candidates are having a tough time. IRB Infra down 8.5% pre-open. Honasa down about 4%. Interglobe down 2%. Vodafone, we were talking about with new telecom minister in, 4.5% down on Vodafone as well. On the upside, Hutco having another very good day. 6.5%, 7% up as well. Home First and ONGC having a fabulous day. Pankaj, what would be the sectors that you would be really watching out for today?
So hi, good morning. Thanks for having me. I think with the first of announcement coming up, especially on the housing side, I think cement is one sector which has taken a bit of a knock of late. Except for yesterday. So when you sort of look at last quarter, we have seen volume growth being pretty good for almost all the players, the likes of Ultratech, Ramco, all of them. So volume growth was 13%, then you had a pricing decline of 5%, and as a result of it, the EBITDA per ton sort of declined by 12%. Now, our sense is that once monsoon is over, the focus on capex will be there, and cement is one sector where we're quite comfortable with the valuations. You look at tier 1 names, they're trading at 15, 16 times EV by EBITDA, whereas the tier 2 names are trading somewhere in the range of 10 to 12 times. So we find comfort there, and most of the cement stocks we have been positive on, including Birla Corporation, ACC, Ambuja, JK Cement, including Sagar Cement, which sort of did very well yesterday. So I think cement is one sector where I think has been sort of ignored for some period of time, but our sense is that this is one sector which will come back and do well going forward.
We'll watch out for Interglobe Aviation in the session today, along with IRB Infra and Honasa. And good morning to both of you from my end as well. But Indigo likely to start off lower. And Pankaj, how do you think about this? Do you track Interglobe Aviation? Because the question really is that both promoter entities are now putting in some supply there. Crude prices are higher. The stock has rallied. If it starts off lower, would you shy away, or would you use this as an opportunity to buy into Interglobe?
So aviation is something which we have not covered largely because of the volatility, because you need a lot of pieces to sort of get it right for the sector to sort of do well.
Okay, fair call. Rajat, can I ask you, how do the charts for Interglobe Aviation look like? Because it will start off lower today. Is that an opportunity, or could there be further downsides from a trading or an investment perspective?
See, if it were to open weak and fall below 45.29, then there would be some problem, because this was the earlier high. And if it were to go below yesterday's low of 4385, in that case, the breakout that happened yesterday would be totally nullified. However, unless it falls below 4250 to 4200 support range, it can bounce back again.
Okay. There are other two, by the way, IRB Infra, and that too should be starting off lower. I presume the pre-open rate's about to settle in. Let's see what those stocks are doing, by the way. Interglobe, we know, is starting off lower. IRB, another 7.5% today. Is Honasa reacting as well? Okay, that's a great plate. In one plate, Interglobe, IRB Infra, Honasa, 3.5% lower. Pankaj Pandey, you track any of the other two, Honasa or IRB Infra? Any views on IRB, for example, or any other infrastructure name?
So within the infrastructure names, what we are liking is one is obviously NCC. So that is one company which we have been liking. They are already sitting on a good order in book of nearly 50,000 crore plus. And I think what we are also liking is some of the other names like, say, Patel, where we have a target price of 20, and also PSP, because our sense is that this company will deliver 31% kind of a profit CAGR growth with better margins. Balance sheet side, things are quite good for the company. So from that perspective, these are some of the names. And we are still working on some of the names where, so this is one space besides cement, which we are liking.
Okay. But clearly the stocks are starting off lower today, so bear that in mind. I wonder if Raymond is starting off well, because that stock has gotten yet another order, so that's to be kept in mind. And by the way, something that Tamanna pointed out, some of those housing finance companies are doing well in today's session too, because the top gainer on the Nifty 500, as the index is flattened completely, is Hutco. Hutco is up 5.5% in the session today. Maybe some impetus to construction. NBCC is up about 4% today. And oil upstream is taking heart from the oil price uptick, because ONGC is up about 3% today. Watch out for these. Rajat Bose, ONGC on the charts, and then we'll get in our colleague to talk about some brokerage notes, but ONGC on the charts.
See, regarding ONGC, what I would say is that, look, there are some stocks like Cipla and maybe even Interglobe Aviation, although it is not performing today. But most of the stocks, the way they failed last Tuesday, it hasn't crossed certain moving averages. In this case, in case of ONGC, it is the 20-day and the 50-day moving average. These are very critical moving average in a short-term play. 270 and the other one is the 268. So you have to see whether ONGC stays above 270. If it were to do so, in that case, there will be a possibility that 280 to about 284, the high of last Tuesday, might be rescaled. A lot of stocks need to nullify that big black candle on last Tuesday. Unless they nullify that, you will not see much of an upside from here.
Okay. That's a good point as well to focus on. By the way, it's a packed house today on NDTV Profit because while we had this fantastic conversation with Rhythm Desai, there is Mr. Vallabh Bhansali coming up, there is Anish Shah coming up, there is Sridhar Shivram of Enam Holdings coming up as well. So it's a really smart show. And at some point of time later on, we'll also be bringing you a conversation with an AI-based conversation from Wipro. So I think it's looking like a very solid day at NDTV Profit. Not that others aren't, but watch out for specifically today. Okay, some brokerage notes that came out. One of them was Nomura on KEC International, and that stock, wonder if it's reacting. No, not really. It's had a good move already. The other one is Elara Capital on Hindustan Construction, and wonder if that stock with that 65% upside at HCCs that Elara is putting out is reacting. I know about 3.5% higher today. Quite fantastic, Tamanna, for somebody to put on out saying that this erstwhile or this long-standing infrastructure major could have a 65%. Not erstwhile.
Erstwhile to nahi hai. It felt
but
like
long-standing.
No, long-standing. So they have a track record, Niraj. They have a formidable.
C-Link.
I mean, they've built the C-Link. We're still waiting for the second part of it to open. The first part opened several years ago, so that's a bit slow. But yeah, HCC could be one of those sort of ideas that we're always looking for in the market. But just taking a second to talk about the lineup, we have Anish Shah also today, and let's crow about it just for a minute. What a fantastic conversation with Rhythm Desai. In case you missed it, he came to our studios, talked with such clarity. Watch that on NDTV Profit all day. You'll hear from Anish Shah. You'll hear from Vallabh Bhansali. Just a perfect overview of what is happening right now in the market. So it's been a good day already, and lots more to come through the day. Yeah, especially after the policy formation. The timing couldn't have been better. Yeah, the timing couldn't have been better. Now, for the markets at least, you have your pre-open rates settling. And Rajat, I'm going to come to you to, once you've seen those pre-open rates, are you interested in any of these housing finance plays? I'm just wondering, your Hutco, NBCC in that category, Home First. I want to see what Aadhar is doing today or what Aadhar has done in the pre-open session. Aadhar Housing was about 6% up yesterday. Do you like any of these?
Well, Hutco looks pretty good. Hutco, if it were to move up from here again, I would use the last Tuesday's high that was 286. If it were to take out that, then you will see a continuation of this up move. Otherwise, what worries me for a lot of stocks is that compared to the volume on the downside, on the upside, the volumes are not coming up so much. But Hutco is one stock that saw good volume yesterday, and if that is repeated today, that volume is also there and it is moving up, then Hutco can definitely post a good rise from it.
Okay. So Hutco is one that you find exciting. Pankaj, I'm not sure if you track Hutco, but if you don't, what would be your best strategy to look at, all of the portfolio announcements that have been made? Do you see any kind of a long-term play here based on what we've seen last evening?
I think, so within the housing finance companies, Can Fin Homes is what we like. Hutco we used to like, and I think we could justify it till 190. But I think now the company has changed their business model. Probably they are going to venture into some new areas, which I think we need to sort of figure it out. But our sense is that, see, the kind of opportunity which is going to sort of unfold with the capex, I think all your traditional banks will have somewhat of a challenge, because every bank will have some or the other sectoral limits to comply with. And which is why the room expands for a lot of players, be it REC, PFC, or something like these companies. So from that perspective, this is one space where we feel that upside could be higher. I think it is just that we need to sort of recalibrate in terms of what kind of upside these can offer. But I think overall...
Pankaj, allow me to come in. We're just about starting the markets in 4 seconds. But this morning, after the policy continuity assurance, the markets are starting off flat. And this has got to do with the fact that, one, that the markets have had a really good move in the recent past. Two, the global markets are now waiting for the FOMC outcome tomorrow. Nifty Bank about 1/3% lower, and I think that's the principal drag. Mid caps though higher, and small caps, which were very active yesterday, also higher in trade. Wonder if Nifty IT is sulking much like what it did yesterday. Maybe not, because banks are down. Something needs to shore the index up for it to be flat. Let's get the heat map up on the screen and show you what's moving and what's not. So even Stevens, actually, while we are flattish, what's pulling off? I think ICICI Bank being lower is the key reason why, maybe coupled with Axis Bank, that the markets are flattish. HDFC Bank to about 0.5%. So it's the banks which is the reason why the indices are dragging a bit. Leave banks out, we might have been better. ONGC's up. Actually, PSUs are not doing all that bad. ONGC, NTPC, there is Power Grid, there is Coal India. So I think those set of stocks are doing okay. NTPC, of course, up 1.5% yet again. Mahindra & Mahindra was losing out yesterday. I think it's just come back a little bit, but moving around. Nestle is the other interesting one. Yesterday was a big mover, today too in the green. Britannia coming out in the green. I wonder if the market senses something around, staples and some measures out there, because clearly 2 days on a trot now we've had some of the FMCG names do well. But as we speak, it's essentially about the oil upstream names, ONGC, maybe Oil India too could be in the green, by the way. And the companies which get negatively impacted because of a crude uptick, Asian Paints, BPCL, etc., along with banks being in the red, Tamanna.
Yeah, absolutely. Perhaps the first decision on the next installment of the Kisan Nidhi Samman, also seeing that uptick in staples. Remember, crude prices have gone up sharply overnight, though they may not sustain there. That's why ONGC in focus. But let me just talk about a few stocks which have been doing well in the broader markets. And I want to take a look at how HUTCO is doing this morning. HUTCO, NBCC, Home First. Now, the government has, as one of its first decisions in the cabinet, decided to build 3 crore homes under the Awas Yojana, which is a government scheme that gives housing for the poor. Look at all of those stocks doing very well. HUTCO really on top of that list, 6.5% up on an otherwise flat market day. Block deals are also dominating the narrative today. Honasa, Interglobe, IRB Infra, all 3 of them seeing block deals and stake sales all in the red. IRB Infra taking a knock for a second day in a row. Remember, the floor price of that block deal was 10% discounted to yesterday's close, where it had anyway fallen 9%. So you're seeing that pain point. RVNL is one I want to talk about. In fact, we should look at all of the rail stocks, but we'll just see RVNL for now, 2.5-3% up. They are in a joint venture with Siemens. They've got a deal from Bangalore Metro, and that's causing some excitement on RVNL. Poonawalla FinCorp, they have a management change, but their former MD and CEO, Abhay Bhutada, is selling about 76 lakh shares, so 3% up on Poonawalla FinCorp. Vodafone Idea is one to look at. They have a fundraise plan. In fact, their plan is to give vendors who they owe money, equity or convertible debt in lieu of what they owe. Very simply put, that stock flat, and at least in the positive after seeing a negative view in the pre-open session. So these are just some of the ones that I spotted, Niraj. But overall, I would say that after all of that excitement and frenzy, markets taking a bit of a pause.
much ado about nothing, but not really. Like Tamanna said, it's just a bit of a pause. We don't know how this will shape up. But again, maybe just the global factors at play here, really, which is leading to this. Yeah, I wonder, as I said, if Oil India is also trading firmly in the green, because ONGC certainly is. Oil India, about a couple of percentage points. So that's one. Today, some of those, and wonder some of those TDP linkage stocks are coming off because it's such a breakneck rally. So Heritage Foods is down 4.5%. KCP is down 6%. Wonder if Ramco is correcting as well. Amara Raja is down. Remember, Ramco too, actually in the green, 882 and counting. So good going for that one. So that's the other piece. And the brokerage notes, Tamanna highlighted both KEC as well as HCC. But KEC is up 1%. HCC, I think, is the one that has really given a bit of a breakout. So watch out for these as well. Rajat, on those stocks which have had such a great rally, Ramco, KCP and Heritage Foods, what would you do here? Would you take money off the table completely, sell out completely, or are the charts strong enough for keeping some of the positions still intact onto those? Any of those, even a Ramco Cement for that matter.
Let's discuss KCP. KCP started rising from about 175 or even lower, 160 last week, and then we saw a high yesterday around 273. So if it were to fall up to say something like 225 or so, I would say that you can actually buy more. But if it were to fall further, then probably there will be more of a consolidation again, and it will take some time. But I think a similar kind of situation you can get in FACT or RCF. FACT is one stock that is FACT. This is one stock, if it doesn't fall below 780, 780 is the first support, and then 760. You can still buy because the kind of volume that it generated yesterday shows that there is a lot more leg on the upside. Maybe that would be punctuated by some profit taking by the short-term players, but FACT looks pretty good.
So FACT is one to look at. Realty stocks doing okay this morning. Prestige, Phoenix Mills, DLF, etc. No real connection to government's housing schemes, but overall, if you have a positive capex cycle, you have a positive economic outlook, then real estate tends to do well. Rajat, anything you like here?
You mean to say housing companies, realty companies, then
Realty.
DLF definitely looks pretty good. And you are looking for housing finance companies or?
Realty. But you can tell us both, it's okay.
In realty, DLF looks really good. And coupled with that, you can choose Godrej Properties, because that is, in my view, that is the best housing, realty company in the market.
What about NBCC? You like NBCC, Rajat?
NBCC looks good. NBCC is also moving up, but then NBCC is a large-hearted entity. It has to take others' problems, and thereby its upswing gets punctuated by all those. So I'm slightly wary of that. Actually, there was a time when I lost a lot of money because it had to bear some other company's burden for whatever reason. That's why I don't venture into NBCC.
Okay. Pankaj, you have a view on NBCC?
We used to track this company, but the challenge with this is that this company works like a Sarkari contractor. So you get 5-6%
Sarkari contractor. It is. I think it is a Sarkari contractor.
Yeah.
Pretty much.
But
It's a great
see,
company.
it's very difficult to take a call on the margins on a sustainable basis. So, which is where the challenge lies.
Okay. Actually, that's the very reason it's up today, because the way you described it is perfect. It's a public sector enterprise under Ministry of Housing and Urban Affairs that have just announced they're going to build 3 crore homes. So, which is why perhaps you're seeing NBCC up. Pankaj, do you track Raymond? Their reality, outreach has been quite aggressive. They have one more property they've announced yesterday in an exchange filing in Bandra East. Do you like Raymond?
So within real estate, what we like is Brigade, which is our top pick. And besides that, I think Mahindra Life is something which we have been liking for quite some time. I think this company has got a lot of potential in terms of the kind of run rate of what it can achieve going forward. So that is another one. Raymond, we don't have a...
Got it. Okay, railway stocks. And Titagarh was up 10% yesterday. Wonder what it's doing today. But Jupiter Wagon certainly in the green. And wonder if Texmaco Rail or Tex Rail is also trading well. Jupiter is certainly up 7%. Tex Rail is up about 5%. These stocks under your coverage, Pankaj, railway stocks?
I think all of them have rallied before we could sort of catch them. But I think we are liking the entire PSU as a lot, because if policy continuity is going to be there, be it PSU banks, be it other PSU names, even on the defense side or even on the other segments, I think those will continue to sort of find favor. That is what we believe.
Okay. Rajat, any thoughts on these railway stocks? Jupiter is up 7%. Titagarh is carrying on from where it left off yesterday. Can they do more?
But out of these 3, I think, of course, Titagarh is fine. It's also showing lot of buoyancy, but Texrail would be a better choice. Texrail, if it were to cross 210, then you can expect 230 to about 235, and its chart pattern is very good. In fact, 230 it can reach over a period of, say, next couple of weeks or so. So I would bet on Texrail with a stop below, say, 200.
Transformer and Rectify also having an interesting morning. They are QIP opens today. They're raising about 500 crore rupees, and that stock about 3% up. Any views here, Rajat?
What is the stock?
Transformer and Rectifier.
Just a sec.
Okay.
Yeah, it is actually crossing, it's trying to cross its high. This is the 3rd attempt to take out, say, 760 kind of levels. If it were to be successful, there is every possibility that it might, because the 9-day exponential moving average is constantly guarding it on the downside, and it is not violating it. Only once it did. So once 760 is taken out, you will see further upswing that might take it to 780 to about 784.
All right. Thank you for that, Pankaj and Rajat. Great to have you on the show today. We're going to take a very short break, but remember, all our very, very exciting conversations on the other side. We'll be speaking with Inam Group's Vallabh Bhansali, talking about the roadmap ahead for Modi 3.0. Stay tuned.
back with India Market Open, and the day post the pieces being put out on the ministries, the markets are laboring along, not least because of what's happening locally, but because of, my suspicion is because of what's happening globally, and which is that the markets would be on tenterhooks ahead of the FOMC decision on Wednesday. But this market is beyond what's happening on a particular day or on a particular week or a particular month. I think the guests that we've spoken to have adhered to that. So we had a chance to speak to Inam Group's co-founder and chairman, Vallabh Bhansali, and I begin by asking him about the roadmap ahead for the BJP-led coalition government and what it would mean for risk assets. Listen into a small slice of that conversation.
So I think we cannot look at coalition without its leadership. So if you look at India's history over the last 30 odd years, we have had many coalition governments. So you see a coalition government with a strong leader, or you see a coalition government with a weak leader. And the moment you reflect through this prism, you can see that a coalition government with a strong leader had done very well. If you look at the change that the first major coalition government, 1991, Mr. Narasimha Rao, there's history today, he gave India the economic or the large dose of economic freedom. We became independent really due to Mr. Narasimha Rao. Then you had Mr. Vajpayee, who had a coalition government but a strong leader with clear head, etc. Then we had a coalition government for a long time, but maybe the leadership was divided or whatever, etc. And so they built on the momentum provided by Mr. Vajpayee, but they lost their way somewhere, and whatever happened, and then we had this big slump from 2011-12 onwards, which went on for a long period of time. And now you have Mr. Modi, a strong leader, and they look at the kind of statements that have come in the last 4 days from his partners, from the world, etc., that, oh, this is so much more to look forward to instead of, being worried about.
Right.
And I am locked into nature, and I try and read those signals. And I clearly see this, that if had nature wanted Mr. Modi to be defeated, it was easy. Nature has said, I've given you a shock, I have not defeated you. So I think Mr. Modi, knowing him, he is going to take this very seriously, and he looks forward to, and we can talk more about it, that how many good things do I see out of this kind of government. So I think I have zero worries about this coalition, and the partners that he has got, and particularly Mr. Chandrababu Naidu. Mr. Chandrababu Naidu is the original progress thinker of this country.
True.
Way back 20-25 years, or maybe more, he was the one who was building the metro in Hyderabad, the electronic city, the new airport and whatnot. So to have two of them together with the major partners, I think speaks wonders about what to expect.
Got it. So to the one with the hammer, every nail looks like it has to be shot into the wall without whether it's needed or no. I heard you say that PM Modi might be looking at how many good things can he do in the new 3.0 era. I would love to understand what you mean by that, and I would love to understand how you think about what are the good things that can come out of the next 5 years at the very least.
Several things. Okay. Say, for example, there were many things that were talked about. Some were politically sensitive, but there were many others that had been talked about little, but not as much. Just take logistics. So when you have somebody like Chandrababu Naidu and the fantastic amount of work that has been done, you just see Bombay, right? We talked about the noise around. Just look at the amount of work that is being done around Bombay. Already, when we go to Flame University, our time has come down from 3.5 hours to 2.5 hours. So imagine the kind of productivity gains. And to Mr. Modi, this is not a stray development. He has worked very hard to bring down the cost of logistics in this country below 10, which means this is a shaving off a cost of anywhere from 3 to 4% depending upon where it is. Look at the kind of focus he has given on DBT. I think the first round of DBT has happened. The second round of DBT, you will see being attempted very seriously. And once that happens, if we had a more productive Manrega, for example, it's one of the largest government schemes. But still, because of various things, I won't go into too much micro, a lot can happen. They have attempted, delivery of health to the last mile through, their programs and all. Given the fact that, while this was being rolled out and there were too many things on hand, all this could not be pushed. So I think from those of the old agenda to the new agenda, and let me give an idea of the new agenda. See, the world is going through a massive shift because of artificial intelligence and so on and so forth. Where is India in it? India is a very special place in this. That India still has the largest number of people capable of handling this kind of work in the world. What is the amount of work that you are getting today? And maybe IT is not roaring at 6, 7, 8%, on the whole. Maybe it is at 3, 4%. It doesn't matter. The world has nowhere to go. So the work that is being done in GCCs, the work that will be done in the large software companies, you just see how it changes. And the government, the kind of work that has been done in the government, and I think you will hear some of this in the next 30, 40, 100 days. So I think that's a whole new ball game.
Okay. So, sir, 2-3 questions weaved into one. We can go them piece by piece, but I'm just weaving it because you kind of referred to two or three things out here. One, I would love to know, what do you think about the 100-day plan in your mind? PM Modi has, of course, announced a 100-day plan just the day after the exit polls, or at least did a meeting for the 100-day plan. Sorry, I correct myself. Two, from a perspective of policy continuity, so many question marks around that. But even when one doesn't know the cabinet, the fact that there are 2+2 seats given to the allies, which means that the government has approached this from a policy continuity perspective as well. Would you second that? Part two question is that. And the third one is whether you spoke about some of the reforms that have been done. Is it time to actually enjoy the benefits of some of the reforms already taken, or have a hard reform agenda in the next 5 years, even if it may disrupt growth a little bit, because reforms can disrupt growth in the short term?
So, firstly, policy continuity.
Yes.
100%. So let's not mistake political policies, and they are not economic policies. Let's see, they are noisy, and we don't even know whether there was a big plan to do any of that.
Okay.
If there is a 370 kind of move, nobody will know about it. Nobody knows about it. So leaving that aside, I think policy continuity is going to be there 100%, I'm telling you.
Okay.
And I think he has been able to establish that with his allies in the last few days. And he has convinced them. If you listen to the body language of the allies, that they are all praised for Mr. Modi, they are looking up to him, they are calling him a great leader, so they recognize they have nowhere else to go, and why go when this is so good? So policy continuity is going to be there. There will be things where he will say, all right, Andhra, you need some special treatment, Bihar, you need some special treatment. Or, the election results have given some feedback as to, something needs to be done at the ground level. They will be very small in the totality of the 100-day plan or policy continuity. So as a matter of fact, all are going to join in keeping the policy continuity. After all, India has become a shining example in the world, the fastest growing major economy, and so on and so forth. They see it, they're seeing it. Why would they want to change it? So it's not changing at all. Number two, you talked about the coalition ministers and things like that. See, in a 293 people coalition, and out of which some are independents and 1% parties who are not thinking like others, Mr. Modi has given them 1/6 of the seats, 1/6 of the cabinet places. That's where they really are, their seats are counting. And more than that, he has shown that, look, it is not in the numbers. You contribute to the government, you will get so many opportunities. There are so many positions within the government, outside the government, where the government can influence them and they can have their way. To a state like Bihar, getting a solid package means a lot more than just having, numbers there in the cabinet, for example. So I think many deals of that kind would have happened. And what is your last question?
My question was reforms that have been done already.
Oh no, Niraj. We need so much reform.
We do, yes.
See, most people are not ready to understand that India needs to make a major migration from what it was to what it needs to be if it really wants to be a Viksit Bharat. Viksit Bharat is not possible just by doing the job work for the world or by doing low value addition. We need a whole lot of new reforms where emphasis changes. You may not have to do much, but when you change the emphasis. So my suggestion, and some of it has already gone to the government, not because of my work, but because of, collective work of a lot of people, that you heard the expression product nation in BJP's manifesto. Something to the same effect in Congress manifesto also, which means this recognition that we cannot just be a job work country. We need to make original IPR and so on and so forth. You also need productivity. And Mr. Modi understands this very well. So when he talks about logistics, he's talking about productivity. When he talks about DBT, one of the reforms that I expect will be in the judicial front, which is really raising the bar on ease of doing business, on what is called the rule of law. There is no rule of law if you cannot enforce the law. So I will be very surprised if you don't see major moves on judicial reform. So you're going to see things like that. And so productivity, quality. Where are we on quality? Mr. Modi said in his speech that he sees a Bharat where people will want to meet and shake the hand of a Bharatiya. This is kind of his ambition. Where is the question of consolidating on reforms? He is a man in a hurry, and we need to be in a country in a hurry because you can otherwise get trapped in what is called the middle income. You get the low kind of demographic dividend. You don't really get the high quality demographic dividend. We cannot be happy with 6.7%, 6-7%, etc. At our level of per capita income. Most countries that have progressed, they broke through and they were at 8, 9, 10%. We need to push growth, and you will see this government attempting even higher growth.
Well, thanks so much for tuning into this very special conversation with Dr. Anish Shah. The new government is formed. The portfolios, in all fairness, may or may not have as much of an implication to the overall business confidence, because we know overall the construct by virtue of the ministers who've been sworn in as well. So let's try and understand what is it that India Inc. might want from the new government as a whole. And joining us, as I said, to talk about that is Dr. Anish Shah. Dr. Shah, great having you. Thanks for taking the time out. For you, Dr. Shah, and for the industry at large, is it a need for further reforms coming in soon? Is it the need for policy continuity, or is it for reforms which have been taken for the last 5-7 years to now start bearing fruit, and no immediate need of earth-shattering reforms needed from the new cabinet or the new government?
Niraj, good evening. Pleasure to be here with you. And at FICCI, we've been working a lot with our members and sharing their thoughts with the government. A lot has happened over the past few years. And the focus that the government has had in the past few years on long-term growth, and therefore on CapEx, which is a greater multiplier effect, has started to see fruit. Now, it does take some time for that to happen. At this stage, we would want, as an industry, more of the same. In fact, maybe ramped up a little more. What we would ideally like is in 4 key areas. First is in manufacturing, make in India for the world. How do we create lower cost for manufacturing, make it easier to do business than it is today, and position India as a high-quality nation? That is going to help us make in India for the world. The second is around women-led development, women in manufacturing, many other initiatives to get women into the labor force, and really position equality as a key focus area for us. Third is around farm prosperity. It's on the value chains from farm to fork, increasing efficiency at farms, enhancing farm productivity, and thereby being able to do more with less. And finally, around sustainability, around water positive as a country, building sustainable urban cities, and playing a key role in the green transition from a climate change standpoint. These are the key areas of focus that as FICCI, we would want a lot more as we go forward. As I said, a lot has been done, and therefore just continuing that path would be a very positive one for us.
Okay. There's a lot of talk around that while there is an added RBI dividend kitty with the government, rural has been hurting, and therefore out of the $100 that the government has in total for spending on either capex or infrastructure or rural spend, and typically, how can a government influence near-term growth? It is by some fiscal impulse. So there's a lot of chatter about whether the government does that, or does it continue the path of capex, which has got a, how do I say, a slightly medium-term impact as well. What's your sense? What would the industry ideally want, sir?
So if we look at this, Niraj, over the last few years, we've had a couple of very strong years in rural and a couple of years that were weaker. Yes, there has been a lot of view on rural distress. We're seeing some green shoots now. And if we have a good monsoon, we're fairly optimistic that rural should do well. So we would not look for something dramatic on the rural side. Maybe some interventions are required, but on balance, and we'd look at longer term growth. It's easier to have incentives and softs, but from an economy standpoint, the multiplier effect is a lot lower there. And therefore, we should really look for longer term growth and therefore invest in areas that will create that multiplier for that long term growth.
There is the other chatter that people who are thinkers of what the economy and markets could do over the medium term and long term and what could potentially happen is that cost of capital by and large could come off at a point of time when India Inc. and the private sector might now start coming in, not just in bits and parts, but in a major way into doing private capex. You think there is anything that the industry could expect from the government from a cost of capital perspective, or could it be a natural curve downwards as well as globally over the next 12 to 18 months? countries start lowering the rates, if they do, that is in the first place?
I think the key is for us to keep inflation in control. And we would give the RBI a lot of credit for the proactive actions they've taken in doing so, because having inflation out of control is in many ways much worse than having a slightly higher cost of funds. And therefore, that is the first agenda that RBI has, which we would fully agree with. And as inflation continues to stay in control, which it has, we're starting to see global trends where certain economies are starting to reduce rates, and that will have an effect on India as well. And it's likely that we will see reduced rates. We will, again, rather be a little more hawkish to make sure that inflation does not rear its ugly head again. But as that happens, as the economy stays on a good path, I think it will only be a more positive picture for us if rates go down.
Yeah. Now, Dr. Shah, I heard you say that you would expect some bit of, if I can, I mean, not verbatim, but a bit of a present continuous, if you will, that what's been done in the past continues into the present and into the future as well from the government side on the policy. A few things stand out. The whole, aside of the, leaving out the financial pieces, which is the whole JAM Trinity, Jandan, etc. On the other side, the focus on manufacturing, electrification, power, electric vehicles, defense, and a few, which were maybe the cornerstone of Modi 2.0. What, to your mind, is something that you are maybe raring to hear and having more clarity around within some of these pieces or newer areas that even Mahindra as a group might be going in? Or as a head of FICCI, you are hearing from your team members?
I think the key for us is going to be around stability, around policies that will help manufacturing, policies that will help on the farm prosperity front, to repeat what I had said earlier. And we've seen a fair amount of progress in the past on that. If we see that progress continue, I think that would be a positive aspect for us. And if we see that progress accelerate further, that would be even better. So on balance, I'd say nothing that's dramatically different from what we've seen so far.
Couple of questions. One is on growth. There is a natural curve of growth that India is enjoying right now. Would you reckon that, there are two ways to look at it. One is to try and give some bit of further impulse to this growth via fiscal measures or otherwise in order to take it higher from the 6.5, 6.8, whatever number that people peg FY25 growth to be like, simply because people say that if we don't do a growth long enough, then the demographic dividend might not remain a dividend per se. The other way to look at it is that the world growth is still anemic. Don't try and further stimulate something at this current point of time and save the gunpowder for maybe a future date. Which side do you veer on?
On this, Niraj, FICCI was the first to, in fact, forecast that India's growth will be 8%. FICCI did that in December last year. And we have hit 8% for fiscal 24. As we look at fiscal 25, again, we are fairly optimistic on the growth agenda there. I think India is well positioned. India is going to add more to the global GDP than will the European Union in the next 6 years. And by 2028, India is poised to be the single largest contributor to the global GDP. So we are on a very strong path right now. And I think it's important for us to continue developing the building blocks for the future, not something that's short term. The main message that we would have from industry is continue to focus on the long term, continue to put the building blocks in place that will help build a stronger economy and that will have a benefit across all sectors of the economy.
Okay, so no immediate pressing needs to have a large stimulating measure to further enhance growth, which is looking at about 6.5 to 7% for FY25. Whatever the number may be, I'm not putting the number to your name. I'm just saying, assuming that that's the range that everybody is working with, you believe that is okay. There's no further need to have overstimulate that at the current point of time.
Yeah, we believe that it's not about a short-term stimulus. It's about having the right building blocks in place, the right investments in place to be able to create long-term. And the only other point I'd mention there is inclusive growth, because this is growth that has to have all sectors of the economy, all segments of the consumer along with it, not just in certain pockets.
So no major rural focus stimulus. I mean, rural has been hurting in select pockets, not overall. Would you believe or would you want either of the two that there could be some not overt measures in order to help that segment?
I think we need to monitor rural closely. We've seen some green shoots in 2 months. The question is whether that continues or not. We will see how rainfall comes up. And that, I think, will give a better sense of should there be a greater stimulus, which is more shorter term, versus measures that the government should take to really transform certain aspects of farm productivity, for example, or the farm value chain, which will have a much longer term impact.
Got it. Okay, Dr. Shah, with the clarity that we have thus far, this is lovely. Maybe we talk to you again post the budget to try and understand what's your thought on as things have come out of post the budget from your perspective or from FICCI's perspective. But thanks so much for speaking to us today.
Sounds good. Thank you, Niraj.
Yeah, the pleasure is ours, and viewers, thanks for tuning in to this broadcast. Thanks for tuning into Talking Point. I'm your host, Niraj Shah. The case for a chat today with our guest. And you could frankly talk about multiple things simply because we've just had the cabinet formation yesterday. So we will obviously invoke that, but our guest today looks at that aspect of the markets and investing very closely too. So we will definitely talk about policy focus. And will that really aid consumption, or will the mantra still remain investments and capital formation, if you will? Will power companies drive the next leg of the PSU rally if there is a continuation of the PSU rally, that is, or will, and power companies have done very well in the recent past, in the first round itself, can that continue? And our guest was amongst the first ones to really identify and possibly invest big in PSU banks way back in 2020. And we've seen a stupendous rally for them relative to private banks. Can that reverse, or will PSU banks still remain the better idea? Well, all of these things invoked over the next 20 minutes with Sridhar Sivram, Investment Director, Inam Holdings, with us in our studio. Sridhar, so good having you. Thanks for taking the time out.
Thanks for inviting me, Niraj.
The pleasure is ours. Did last evening surprise you, because the markets were bracing that what if it's a tougher conversation? And is that net positive from an investor's mind that there's probably larger policy continuity, at least amongst the key portfolios?
No, I'm not very surprised, because the key portfolios were expected to be with BJP. And it's good to see there is continuity. So broadly, we have same ministers continuing. So to that extent, I think it's positive. I don't see there wasn't too much of a surprise there. So I think there was speculation on the finance ministry post, but good that is settled.
Good that it's settled. Yes, indeed. So now, back to basics. Maybe wait for the budget and some policy announcements, but keep an eye out on the globe as well. FOMC tomorrow, so on and so forth. What do you think now drives market sentiment? Because while we are obsessed with our election, the bigger election is happening in November in the US as well, and the Fed commentary and the Reserve Bank India. So many things out there in the cocktail, as always is. But to your mind, the next 6 months, what drives your attention?
I think inflation, both domestically and globally. My own personal view is that inflation is becoming very sticky, especially towards the last leg of it. So for the US to bring it down below 2, for India to bring it down below 4. I don't see India's inflation below 4 in the next 12 to 18 months, not because of the core inflation, but because food is becoming very sticky. And that is resulting in the inflation number being higher. And we've had some policy related discussion with the ministry level, and we've highlighted that maybe this is not the right benchmark to look at, because 55% is food, which cannot be controlled by monetary policy. Now it's up to them and Reserve Bank to finally make a call, because if you see WPI has collapsed, literally telling you there's no pricing power, and it has achieved the purpose, which is 275 basis points of rate hike, and you've got the result, but no result with food. And obviously you don't expect food to get impacted by policy decisions, but that's how we are right now. Let's see if there are any changes to that. If not, we'll struggle to bring inflation below 4. So that's how I see higher for longer. And even for the US, I think it'll be very sticky. It'll be very difficult for Fed to actually cut substantially. And that has its own challenges as far as equity markets are concerned. So I think it's a challenging next 6 to 12 months is how I will put it.
Okay, so if indeed the hypothesis is that inflation doesn't come down and rates don't move, then do the markets just amble along at these, or would you believe there is a higher probability of a downward bias as opposed to even the markets maintaining their valuations and levels?
Yeah, so I would say amble along possibly. I don't see a major correction. Okay, I could be wrong, but my broad framework is that we could see a time correction. Obviously, markets, as they move, there's always 4-5% correction. But I don't see like a 20% correction or something like that. But time correction will be good, because it gives the earnings to catch up. We've had very strong earnings growth till now. We think earnings growth moderates in FY25, and the markets will take some time to digest that. Given so many other challenges that we have, I think it'll be great if the market takes a pause and it stays here for a while. But normally what you wish doesn't happen. So we'll always see rational exuberance both on the upside and on the downside. So let's see how things play out. My base case is that it ambles around for a while as earnings catches up.
But, and is that a good outcome? Because frankly, there is a lot of specific sectors, as there always are, which can do well if the market doesn't have a very sharp downward draft or a downward trending market. So maybe that is a good outcome, that the markets, the Nifty or the benchmarks stay as they are, but individual sectors, because of policy, earnings, or a combination of both, can maybe show some traction.
Yeah, so if you see year to date, Nifty is up 4-5%. We've had enough volatility in the interim, but the net result is that we're up, but nothing spectacular. So I think the same will continue, in my view, for some more time, because there are some sectors which are struggling. There are some sectors which are doing well, and market will try to digest all the information that we have. We've had a massive election results which has just come and gone, which had its own set of volatility, but if we remove that 1 week, it looked as if the market's exactly where it was. So I think we've learned to live with a little bit of volatility. On the balance, I think it's a phase where market's trying to digest all the new information and possibly the earnings that we will see now, and then it'll take a view from there on. That's how I see.
Okay. So the one thing that is, in a sense, caught the imagination of people about whether the government will do any kind of fiscal stimulus-led measures to boost rural/consumption, or will it, as it has for the last 5 years, continue to focus on capex? Now, the answer only the government will be able to tell us, but we can all build a hypothesis. I would love to know, how do you think about this, and is there a resultant impact on how you think about investing within those buckets per se?
So I think for the current year, the government has possibly 1 lakh extra because of the RBI dividend, which could go trying to boost consumption. So I don't see any change as far as capex is concerned. Keep in mind that there's only that much capex that the government can do. Even last year, 10 lakh crores, they just barely managed to spend the entire amount. Our amount is about 11.5 lakh crores. There is the absorptive capacity is not that much. You cannot just say I'll do 15 lakh crores and you'll be able to do it, because these are long gestation projects. You need land acquisition. There are many other challenges to it. And I don't see the government being extremely benevolent as far as consumption and giving out, doling money is concerned. I think they're committed to the fiscal deficit number for next year, which is around 4.5. And I don't see that changing. Within the constraints, I think they will reallocate some resources to ensure they whatever they can from their side to boost consumption. I don't see anything major.
No populism.
I don't see. That's how I look at it.
But even if they were to do it, can capex and populism coexist?
As I said, for the current year, we have 1 lakh crore extra. So we could easily use that 1 lakh crore for the so-called populism. For the next year, we'll have to see how the budget numbers play out. Our taxation growth has been extremely buoyant. So given that if your taxation is buoyant, to that extent you can use it for consumption. I doubt it will be extremely populist. That's my feel. We'll get a sense when we get the interim budget or the final budget now. I doubt if there's going to be any major change. That's how I read it.
Okay. Viewers, I'll take a break right now and come back from a break, because frankly, I can do a 1-hour conversation if Sridhar has the time only on macro. He's so good at that. But he's brilliant on the micro as well. At a point of time when everybody was so gung-ho on life insurance companies, Sridhar pointed out that this whole hype about under-penetration is not true. the stocks have virtually not given market-beating returns. They were amongst the first ones to identify PSU banks way back in 2020, as I said. They've given phenomenal returns. So I want to focus a bit on the micro as well, and how does he think about that landscape. So we'll take a break, come back and talk about the micro. Stay tuned, you don't want to go anywhere. Back with Talking Point right here on NDTV Profit, in conversation with Sridhar Sivram of Inam. And Sridhar, it's great to get your perspective that one, policy continuity is good, and that you do not believe that there will be excessive populism, even if there is a little bit of populist measures.
Yes.
So therefore, that drives one half of the investment piece. Now, my question is, private capex to an extent has been elusive. 5-10 groups doing it, not very large. I've been hearing about how the corporate balance sheet is deleveraged now for the last 18 months. It's not putting in the money. Will it take for the government to step back for the private capex to come in? Is it something else? Were they waiting for this election outcome to be out of the way? Or is it a business cycle decision that needs something to happen for that capex to come in? And therefore, so one, will that happen? And two, is there a way to play it via the equity markets?
So I think it's a combination of all these factors. I think from the government's standpoint, they've done everything that they could to spur private capex, from a tax cut to all sorts of incentives, PLI schemes. So I don't think you can question the government's, intention, their, push to capex. I think it's left to the corporates, and normally that happens when your capacity utilization crosses about 80-85%, which we have right now. And the last time, if you see, the big private capex came on the power side, which is, if you go back to 2007, 8, 9, we had a massive power capex which boosted the capex for the private sector. I think we're reaching somewhere similar right now, where if not on the thermal side, surely on the wind and on the solar side, we will see a lot of private capex coming in. Plus, the capex coming in for normal business because your capacities are running into 80-85%. So I think it will come. Election was an excuse which is now behind us. So hopefully in the next 1 year we should see some positive news flows and the actual implementation of the capex. We remain optimistic that the private capex would come in.
But in specific areas with maybe power and a few others dominating, or could it be slightly widespread?
It will be widespread. Unlike say last time, because thermal capacity requires a lot of capital. And last time that was a bulk of it. Even a media company was setting up thermal capacity. So I guess that sort of craziness is not there right now. People are a bit more mindful of capital discipline, rightly so, because markets punish them a lot. So I think it will be a bit